Today's video is part 2 of an interview I did with radio host and financial advisor Josh Jalinski, where we discussed why capital gains taxes are optional and how to avoid them. So sit back, relax, and enjoy part 2 of my interview with Josh Jalinski.
And I love that about your work. It's not like this either or, it's a both. And comment on that a little bit.
Yeah, I mean, I think that's best represented, like I said earlier. If you look at my approach to tax-free retirement, it's not having all of your eggs in one basket. I don't believe, for example, that like you see on TikTok these days, I'm sure this drives you crazy, Josh. You see on TikTok these, it's the wild, wild west out there, by the way, people that claim that, for example, IUL is the end-all, be-all of investments. So they'll denigrate 401ks, IRAs, 403bs, 457s, because they don't measure up to what the IUL offers. I think that's a sort of a foolhardy way to approach retirement. I believe that every stream of tax-free income out there has some quality, some attribute that makes it unique. And I'll give you an example. I typically recommend 6 different streams of tax-free income to my clients. What are they? Roth IRA, Roth 401k, Roth conversion, taking money out of your IRA up to your standard deduction, so that gets offset, so that's tax-free, LIRP, and tax-free Social Security if you can keep your provisional income low enough. All of those streams of tax-free income have something unique about them. For example, the Roth IRA you can touch whenever you want, at least the contributions you've made. None of those other streams of income allow you to do that. For a Roth 401k, it has a match. Roth conversion, you can do as much as you want. There's no limits on how much you convert in any given year. Tax-free distributions from your IRA, that's like the holy grail of financial planning. You got a tax deduction on the way in. You grew tax deferred. You took it out tax free. The LIRP allows you to receive your death benefit in advance of your death for the purpose of paying for long-term care. None of the other streams of tax-free income do it. So, and then Social Security, the longer you have it, the better it is. It helps you mitigate against sequence return risk, inflation risk, long-term care risk. So all of these streams of tax-free income are part of the picture. If you fixate on just one or the other, you miss out on the benefits of all the rest. And so that's sort of that balanced, comprehensive approach that I love to take in my financial planning worldview.
David, you dropped pure gold nuggets. I'll add 2 more. So you said there's 6 streams of tax-free income. I'm going to add 2 more. If it's all right with you. You said Roth 401k, which, by the way, that is a very underutilized thing, because a small business owner can do a solo Roth 401k without any income limitation. You want to talk about that? Because people don't realize that. Roth 401k is very underutilized.
Yeah, I mean, if you look at the typical traditional Roth IRA, you make north of $228,000 of modified adjusted gross income. You can no longer do a Roth IRA, and you're constrained if you're over age 50 to $7,500 of contribution limits. You don't have those same types of income limitations with a Roth 401k. And the Roth 401k, you can put in not just the 22.5, but you get the catch-up of $7,500. So you can put in a total of $30,000 per year in a Roth 401k. So the Roth 401k has a lot of advantages to it. And the great part about it all is you can do both. If you're under that $228,000 modified adjusted gross income limit, you can do the $7,500 for the Roth and the $30,000 for the Roth 401k. And if you're married, your spouse can do that as well. So that's $75,000 of total contributions to tax-free accounts. And if they give you, say, a $5,000 match each, that's another $10,000 that could go into the Roth portion of your 401k. So that's, $85,000 per year you could squirrel away in a tax-free account. And that's before you ever even got to your LIRP.
Wait, how do you get to $85,000?
I assume that if you have a Roth 401k, maybe you get a dollar for dollar match up to 5% of your income. If you're making 100, your spouse is making 100, then that's an extra 10.
And the 37.5 times 2 is a great tip that I knew, but I didn't think of it like that until you just said it. Yeah, because you could, if you own a company and let's say your spouse works for you or with you, you pay them a salary. A lot of times people don't pay their spouses a salary. I would so that they could get that 401k, that Roth 401k. But you might say, but my accountant said I got to pay the FICA tax. I got to pay the W-2. Yeah, but you could get $75,000 a year, 37,500 times 2 for you and your spouse. That's $75,000 a year without earning any interest over 10 years. Tax-free growth, even if you put it at a 4% money market account. People don't realize this. Money markets at the bank are paying out 4 or 5%. That's all taxable. But then the Roth, it's tax-free. So, and that taxable money market, the reason why this is so important now, folks, is there's people I see all the time. They have $1 million of cash, earning 5%. They have $500,000 of cash, earning 0% or 4%. They should not just keep it at the bank because that will hurt them on Social Security taxation. They will hurt them on Medicare taxation. You alluded to this earlier, but break that down, because I think a lot of people are like, oh, goody, my banker is now giving me 4 or 5%. After the bank giving you nothing for 12 years, they're waking up, they're getting better interest rates, but they don't realize they're going to get screwed on taxes because that $1 million of cash or that $500,000 of cash at 4%, extra $20,000 a year that's taxable income. What are some ways, first discuss the problem and then some solutions in that regard?
Yeah, so people got to remember this is all short-term capital gains, which means it gets paid at ordinary income tax rates, which means it gets piled on top of all your other income and tax on the margin. So if your highest marginal tax bracket is 32%, throw in another 8% for state tax. So now you're paying 40% tax on that 4% growth. So now you're, you only made 60% of that growth. So 60% of 4 is 2.4. So now you're barely keeping up with inflation, right? And all of that income now gets counted as provisional income. So if you're in retirement and you're taking Social Security, it increases the likelihood that you're going to have to pay tax on your Social Security. Okay. And remember, if you have to pay tax on your Social Security, you got a hole in your Social Security because of taxation. How do most Americans go about plugging that hole in their Social Security? Well, they got to spend their 401ks and IRAs down to compensate. And that's could cause you to run out of money quite a bit faster than you thought possible, all because we're growing dollars in a place where really the tax is optional. I tell people all the time, if you're paying a tax in your taxable bucket, that's an optional tax. So why not there's a lot of different ways, Josh, frankly, to get money out of your taxable bucket and into a tax-free bucket. You can contribute it to a Roth IRA if you're still working. You can take more money out of your paycheck and contribute that to your Roth 401k, fully fund your Roth 401k if you're not already doing it. You will now have a hole in your paycheck because you've taken money that you would have otherwise spent and you put it in your Roth 401k. Well, compensate out of your taxable bucket. Spend the money out of your taxable bucket to compensate. You could do a Roth conversion. So you can then take money out of your taxable bucket to pay the tax on that Roth conversion. You can take money out of your taxable bucket to fund an LIRP so that you have long-term care. And if you die peaceful in your sleep, never having needed that long-term care, your children or grandchildren are still getting a death benefit. So there's all sorts of different ways to get money out of that taxable bucket if you have too much in there. But suffice it to say, if you pay the tax of that taxable bucket, it's an optional tax. You don't have to pay it. You're choosing to pay that tax.
Okay, folks, that was the end of part 2 of my interview with Josh Jalinski. If you want to learn more about how to shield your retirement savings from dramatically higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.